information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Now, Top Tips Wednesday continues with Your Money, Your Call.
Energy and resource stocks take a breather today after sharp falls on Monday and Tuesday. However, rallies in these sectors were not enough to save another 0.5%, being shaved off the All Ordinaries Index today, which is now down within 120 points of that magic 5,000 support mark that it's already tested 3 times since August. Good evening and welcome to Your Money, Your Call. I'm Ken Bloomfield from Financial Clarity. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. Joining me tonight on the panel is Chris Conway from Australian Stock Report and Patrick Taylor from Taylor Securities. Welcome, gentlemen.
Thank you.
Hello, Ken. It's been an interesting couple of days, certainly for the energy and resource sector. Some tough news coming out of China again tonight, but it seemed like Australia really anticipated a bit of that, and we had a really bad day yesterday, didn't we, in that sector?
Yeah, it seems like to be a chase to the bottom with resources especially, and nobody really knows where the damage is going to stop. We've got stockpiles rising, the China data hasn't been good, and you know, who knows where the bottom on BHP is going to be. I think, you know, we were talking earlier, maybe $15 before we see a base. But when the markets are rational, you know, it's very hard to start expecting it to start paying attention to fundamentals, and at the moment there's no need to be chasing these things down. Let them base.
It's catching a falling knife otherwise, isn't it?
Yeah, it really
Patrick,
is.
You really don't know what's going to happen. And those fundamentals take a long time to turn around, you know, in the resource sector because of demand and supply.
They certainly do, Ken. So, I mean, one of the things that I've been focused on recently is the structural oversupply in both iron ore and oil. You know, there's just far too much supply out there in the world at the moment, not enough demand. Demand is not picking up. Of course, it is actually trailing off as well, and yet companies like BHP and Rio and Vale continue to ramp up their production. So those imbalances will probably take 12, 18, 24 months to wash through. So as Patrick said, where is the bottom? It's probably not close, I wouldn't have thought.
Yeah, so we get a lot of calls on, you know, we used to get a lot of calls on, you know, the Atlas Irons and some of those second line players. Not quite so many lately, but it's interesting, isn't it? Because people don't really understand why BHP and Rio would keep pumping it out. Why do they keep pumping it out, Patrick?
For money. Like if they're not actually making money, then they can't support the dividend, and then they lose a lot of investors. So they're caught in a trap where everything they sell, the prices are going down. They might even be making a loss on some of it, but they've got to keep doing business.
And because they're the lowest cost suppliers, they figure they're going to be the last people standing, right?
Yeah, we'll have a look at what's happened to Atlas Iron. It's gone from $4 to, I think it was rustling around 1.5 cents the other day.
Oh, was it right?
And that was considered to be the next big thing.
Yeah, 3 or 4 years ago.
Yeah, that's right.
Yeah, absolutely.
But, you know, red hot bargains lead to burnt fingers as well. So that's one thing we need to keep in mind.
So can you say that again?
Yeah, red hot bargains can lead to burnt fingers.
Burnt fingers, there we go. That's the quote of the night so far. Thanks, Patrick. Now, just generally on the Australian economy, guys, you know, we had a sort of a pretty negative tilt on things a few months ago, but we've seen some, firstly, Reserve Bank Governor, you know, talked up the economy, I thought, really, in these last couple of statements. Some good numbers in terms of employment, consumer sentiment numbers, bit of a Turnbull effect there. You know, what do you reckon in terms of the Australian economy going into 2016, Chris?
I'm probably not as positive as the RBA. I think the RBA has an agenda and they don't want to cut rates any further. So it doesn't surprise that they're out there trying to talk up the economy. Certainly the job numbers remain robust and our jobs market is performing, I think, particularly well. But I look at things like housing starts, house prices, they are coming off. Our terms of trade are weakening. So I think there's just as much data on the negative side as there is on the positive side. And I think heading into 2016, early 2016, it's going to be a pretty tough period for the Australian economy. Of course, iron ore continues to fall, as we were just talking about. 1 in 5 Australian export dollars comes from selling iron ore. So there's a big loss of revenue there, big tax losses as well. I think the budget or the forecast is due out next week, and it's going to show that there's a much bigger hole than everyone anticipated. So there's certainly mounting evidence that the economy is slowing.
Interesting, because apparently a dollar drop in iron ore translates to 300 million gone in the budget annually, and that's you know, if we've dropped 40 or 50 bucks in the last 12 months,
About that, yep.
that's that 300 million times that is a lot.
1.2 billion, if my math serves me correctly. Probably more.
Maybe 12.
Maybe 12 billion. There you go. Forgot to carry the one.
So that's a bit scary, isn't it?
Yeah.
It is, and it's hard to see where the drivers are going to be. Like Turnbull's push into entrepreneurialism, it's going to take time, and they're focusing on sciences and startups.
Look, it's great to see, but as you say,
it's going to have a drag time, and it's going to take a while for that to filter through. And in the meantime, we do have, as Chris was saying, we do have some real warning signs coming through in the housing market. I know that where I'm from, which is Mandurah and Perth, the market over there is very soft. And you know, what's going to be the drivers to get that going? Sydney and Melbourne really will be the drivers of any major correction in that market. And if they start correcting, the amount of risk capital that could be allocated to the banks would be significant. I wouldn't. It's sort of an ugly scenario which is going to come through in one way or another, because the house prices, if it's not sustainable, it'll stop, and if it stops, normally it goes down afterwards. So I think there's a real risk there, and the banks are carrying that risk, so we'll see how they go.
Okay, interesting, guys. Thank you for those insights, gentlemen. We might go to our first caller. We've got Neil, sorry. Neil is calling from Geelong. How can we help you, Neil?
Hello, Ken. How are you tonight?
Very well, mate.
I'd like to ask you about IPH Limited. I bought it in the IPO at 210.
Yes.
And it's now trading at 850 or something.
Yes.
Now, they're doing a share purchase plan at 730. Should I participate in that, or...?
Yeah, good question, Neil. Good question.
What's the stock?
Thanks for that.
IPH, gentlemen. Neil, we actually participated in the IPO as well for our clients, and we released a fair bit of stock in the early sevens recently, but we still had some holding in the stock. IPH stands for Intellectual Property Holdings. It's a group of lawyers who are basically rolling out and buying out other intellectual property firms in Australia and in Asia. These guys, I think, have a pretty good footprint. They're doing roll-ups mostly with cash and raised money rather than with debt, which I think is good. We're still pretty positive on the stock. We think probably most of the growth's gone from the stock at this point in time. However, there's good momentum. We reckon they've got more roll-ups to do, and we'd definitely be buying it at 730, Neil, in the SPP, even if it's for a trade. If the stock's trading at 830 or 850, and you know, it knows that there's an SPP out there, a share purchase plan out there, then that's pretty well priced in. So it can have a bit of an effect on price afterwards, but that's my thoughts, Neil. I'm sorry to snaffle that one, guys, but I know that stock pretty well.
You certainly do.
What do you reckon, Chris?
Look, I don't know the stock all that well. I'm just having a look at the chart here. Look, it does look very strong. I think it closed around 854 today. Share purchase plan at 730, did you say?
730, yeah.
So there's a great buffer built in there. Do we know how dilutive the SPP is?
Not significantly dilutive, no. It's not a large amount of capital compared to their market cap.
Yeah, great. So if it's not too dilutive, you'd expect that this stock would just smile and keep on coming. I mean, as you said, the momentum in it is great. It's not showing any warning signs for me on any technical indicators in terms of being overbought or anything like that. Volume is starting to pick up as well, which is showing more and more people are interested in it. So I can't fault this one. Yeah.
Okay, fantastic. Patrick?
Yeah, it looks strong. It's had a couple of sort of minor consolidations sort of in October. And just recently towards the sort of mid to end of November, but it's pushed through both of those. And look, it's running well. It's positive on every sort of shorter term indicator I've got, and hasn't been around long enough for the longer ones. Just trying to see what the general analyst view of it is, and it's pretty well backed. There's 6 analysts that cover it, and it is racing ahead of its average target price. Those targets are increasing. But yeah, so the 6 brokers give it an average target price of 710. It's racing ahead of that, but that's not that uncommon for strong stocks. They tend to sort of run ahead of the analysis sort of justifying it. So yeah, it looks strong. I'm not sure if I'd be buying it. I'd try to maybe wait, see if it comes back a bit off that share purchase plan. And
yeah, I guess that's one of the questions is, whether at this point you'd be buying it or not. And my feeling is, having been in the stock, it feels different, doesn't it? It shouldn't be a different decision, but it feels different if you've been in the IPO and have the stock as to whether you're actually buying it now. But it should be similar decision making, really, shouldn't it?
Should be. I mean, one of the things that should always sort of free things up for you is, if you don't know what to do, would you consider buying the stock now? And if you wouldn't, then it's possibly a sell. At the very least a hold. I would be holding this and looking for weakness. It would be hard to buy it now unless you're a real believer, but believers don't ever sell at the top. So I would try to wait for a dip, see if the share purchase plan will come in and give you that, and then try to use that. I mean, you buy dips in bull markets. So
yeah, good. Okay, thanks, gentlemen. The only other comment I'd make about IPH is that probably the significant growth gains have already been realised in the stock, and you'll probably see it consolidate, I would imagine, over the next little while the analysts catch up with things, unless they do some big roll-ups. But they've stated they don't want to actually borrow too much money, which some of the other roll-ups have been doing, and have caused the market some concern, which means to buy more companies, they'd probably have to do some more capital raisings, which will dilute things. But that's probably enough on that one. We will go to a short break, and we'll be back with more of your questions after this break. Welcome back to Your Money, Your Call. We're still taking your calls, 1300 30 34 35, and emails yourmoney@skynews.com.au. We will go to an email, actually. We have an email from Anne. Anne asks, is there a specific reason for the drop in excess of $1 in Green Cross GXL over the last week? G8 Education has also started heading down quickly. That's code GEM. What does the panel think is behind these drops? Thank you, Anne. I might go to you on this one, Chris, initially, either GEM or GXL.
Yes, I'll start with Green Cross. In the veterinary services space, I believe there's a competitor that is either about to list or maybe a private enterprise that stands to be a big competitor to Green Cross.
I think the code's VET.
VET.
Yeah, and
good code. Makes sense.
Yeah. I think they have listed, actually, but
yeah, okay.
I don't know a lot about it.
Yeah, no, I don't know a lot about them either, but they are certainly trying to operate in a very similar space to Green Cross, so that might have a little something to do with the pullback in the share price. But going back, looking back to probably February, the stock has been in a downtrend. There's certainly bearish momentum in play. From a technical analyst perspective, this is a stock that you'd probably want to be short more than long. I do actually like the stock fundamentally, but the immediate momentum is bearish, and it's probably got some further downside, unfortunately, and before it finds a bottom, especially if that competitor comes hard.
Right. Patrick, what do you think?
Yeah, well, the stock's actually been in downtrend after peaking out near to $11 at the end of 2014. So since then, it's been trying to fight through consolidation, and it's been winning some and losing some. It's had a couple of rallies, but it's really now under sort of major moving average support, which is now resistance. So just in, what was it, around September, it made a leap back up to about $7. Couldn't break through that level, so it was always going to stay under that wet blanket of negative momentum, and it's just breaking support levels. So there was a support level in the last week or two, which was pretty important, around 550, and here, yeah, 564. So as soon as it broke that, it just trapdoored down. It'll find some support at $5, which it hasn't done, actually. The next line of support is at around 457. So this is not one I'll be touching. It is falling. It is in a downtrend. Major negative long-term momentum. It needs to be above 7 before you even look at this for a real recovery. At the moment, I'll be looking elsewhere.
Okay, and GEM was a real darling there a few years ago, G8 Education, but I think the market's got a bit spooked by sorry?
Was it vocation and educational?
Yeah, definitely, and also just the roll-ups. The roll-ups generally haven't been doing quite so well because, of course, when you roll up a business, what they're trying to really do is they're trying to get the benefit of taking an unlisted business or company, roll it up into a listed entity and get a higher multiple for it. But of course, in doing so, they have to take on debt. And the further you go in the roll-up process, the less easy, low-hanging fruit there is. So, you know, and then you start getting bidding wars as well. So I think G8's, the market's definitely spooked by their level of debt. But what do you guys think about, maybe you can start with this one, Patrick, in terms of the technical situation?
Yeah, I don't mind G8. Look, this is one I actually tipped back in 2014 at around the $3 mark. It had a nice sort of consolidation there for about, you know, was it 6 to 9 months, just under, where was it about? Just under 350. And as soon as it broke that, it was a really nice positive signal in the weekly time frame. It made a nice jump. Now, I didn't get the top on that, but it was a nice trade. But, you know, since, when was it, January this year, or even earlier than that, sort of November, December of 2014, you know, it was just been breaking support levels. You know, that's not something we're looking to buy. Interestingly, though, just recently, it's been really pushing against major resistance at 358. It dipped back beneath that now, but we got some longer-term buy signals starting to come back in.
Okay, good. And Chris, G8?
Yeah, Ken, I must admit, as this stock did become a market darling, as you said in the intro, I never quite saw the light of the story. I've never particularly liked their business model. I think they've been overpaying for their centres. And the other thing about childcare, of course, is it's regulated. You know, when you grow a business and expand a business, one of the things that you're really looking for is more and more synergies, but it's regulated. You need to have a certain number of child care workers in a centre to look after a certain number of kids. So some of those synergies that maybe people thought were going to exist didn't eventuate. So I've never really liked the fundamental story. I thought it was drastically overpriced when it was above $5. I think it's probably headed further south. And technically, as Patrick was saying, at the moment, it's looking quite bearish. So certainly not one that I would buy. If I was holding it, I'd be probably looking to get out.
Okay, thank you, gentlemen. Pretty definitive on both of those and both agreeing. So we'll go to a caller. We have Mark calling from Toowoomba. Mark, how can we help you tonight?
Oh, good evening, guys. I'm looking to add some infrastructure stocks to my portfolio. I like Sydney Airports. Can you tell me what risks there are with this stock, and would you recommend it?
Okay, thanks, Mark. Yeah, good question. I might just go to the panel here. I'm a holder of Sydney Airports. In fact, it's our second largest holding in our portfolio, so I will make a comment on it. But, gentlemen, this is one that's really run up hard recently. Funny enough, it took a bit of a downturn there, you know, 5-6 months ago. Got down below $5. I thought it was fantastic buying down below $5. We're now at sort of $6.30, I think, around about today. Ran up to $6.60, $6.70 just last week. What do you think about Sydney Airports? Chris, maybe you can start with this one.
Yeah, look, I actually really like Sydney Airports. I like the story. I like it fundamentally. I think when the Fed raises interest rates and the greenback appreciates and the Aussie dollar falls against it, that might see more tourists coming to Australia. There'll be more through traffic at Sydney Airport, and those tourists will probably be likely to be more willing to spend money because they'll get a good rate on their exchange with their currency that they're exchanging. The only caveat is the valuation. It has run extremely hard, and you know the question does beg, can that momentum be sustained? But I do like the story. Technically, it looks great. Maybe wait for a pullback though. That might be the best course of action. Buy it on a dip, as Ken did around 6 months ago, and he's laughing all the way to the bank so far. So if you can do what Ken did, it's probably good buying on a dip.
And it sort of looks like it's moved. I'm sort of not into the technicals as much as you guys, but I pay some notice to it. And it's certainly moved into a new sort of channel, which is higher than it was before, which to me is just sometimes a bit of a warning sign that don't chase it. You don't necessarily need to chase it.
Yeah, so that same dip that you were talking about, I got a couple of clients into that, but just recently was taking profit just under 650, so I didn't get that 670 top. It just, you know, there are warning signs coming through. And for me, the medium term is the most important time frame, the weekly time frame, and it does dip. You know, all stocks go through cycles. This was starting to run ahead of its valuations. The consensus data on it was was really starting to thin out. I mean, everybody's positive on it until they're not. There's no point being a true believer because you're kind of relying on everybody else to be that as well. There's 14 analysts that cover it. The average target price is $6.12, and this doesn't tend to run ahead of their targets that much, and it sort of has a couple of spikes above it and come back to meet it. So it's an interesting time. I like infrastructure stocks. There's other places to look. I quite like Horizon, amazingly, is doing quite well considering most of the things it deals with indirectly are getting crushed. Transurban I also like. There's plenty out there. You don't have to stick just to the airports. I actually don't mind Auckland International Airport.
Yeah, I like Auckland as well, yeah.
And that was my pick over Sydney, but they've both done well, so you take them as they come.
Yeah.
But yeah, there's a lot of good companies in that space.
Yeah, good. Thanks, gentlemen. The other thing I'd say, Mark, too, in terms of risks, a lot of talk about the second Sydney airport. Sydney airports themselves put out a pretty interesting report on this maybe about 18 months ago. Of course, they're biased. They want to delay the second airport as much as possible. But Sydney actually do have an option to build a second airport. It's going to cost a lot of money, probably somewhere between 2 and 4 billion in round numbers. They want to delay it as long as they possibly can. The government's committed to it. So that's one thing that I think is something just to look at. Sydney's argument was that they can actually build another runway at the current airport, which is interesting. And they backed it up with a fair bit of data. But of course, as I said, they would like you to believe that because the longer they don't have to build a second airport, they do very well in the first airport, and it's a high yield. So that's just the only caveat on Sydney, but I really like the story overall. Now we'll go to another caller. Ben is calling from Sydney. How can we help you, Ben?
Oh, hi everyone. Thank you for taking the time to answer my question today.
Pleasure.
So, thank you. So my question is that I just purchased Origin Energy yesterday at $4.75 through a margin loan. Should I hold or should I sell?
Ben, you're a very brave man. You're a very, very brave man. Now, what do you think, gentlemen?
Put the words right out of my mouth, Ken.
Through a margin lend. Now, obviously, Origin got smashed yesterday and the day before.
Patrick, the last few months.
And the last few months. Yeah. What do you reckon, Patrick?
There's a weird fascination with buying injured stocks or falling stocks thinking that they're cheap. It's kind of like if you were to go to the races and you get a choice to back on the favourite for not so much money, or you get to pick a horse with a broken leg at amazing odds, you're still better off going for the favourite.
Probably the wrong year to say that, Patrick, with the Melbourne Cup this year.
I'm not a gambler, amazingly.
But the odds are, as you say, this is the first time, I think, outside 50 to 1 chances won.
True, but they didn't have a broken leg. And a lot of these markets that are dealing on literally don't have a leg to stand on. I mean, energy's getting crushed, iron ore is getting crushed. And there's this fascination with people wanting to pick the bottom. It's almost like picking a scab you should leave alone, or poking a dead animal with a stick. You see kids do it and it's fascinating, but you shouldn't be doing it with your money. Invest in strength. Origin will have a base and a bottom, and it'll be obvious when it's there. Give away the first 10 or 15%, and come in when it's a better operating company. There's no points for being a hero, and it can be very expensive.
Okay, I reckon there's a lot to talk about in the energy space. We'll come back to that after the break.
I quite like AGL Energy. I mean, it's a renewable energy company, and that, I think, has got some legs, whereas some of these other ones not so much.
Yeah. No, let's get back to the energy space after the break. But if you'd like to speak with our expert panel, call us on 1300 30 34 35 or email your money at skynews.com.au.